Thank you very much. I hope you had a good lunch and enjoyed meeting your colleagues and hopefully friends from the community. Welcome back, and I'm delighted to introduce our keynote speaker for the afternoon, one of them, because we have Luke Johnson later on. But now we have Jon Moulton, who has an unparalleled experience in finance and brings over 30 years of experience in the city, including mid-market mergers and acquisitions, management buyouts, venture capital investment, and angel investment. Jon is non-executive chairman of finnCap. He was a founder and he is founder and chairman of Better Capital and was managing partner of Alchemy, a UK-based private equity firm which invested over $2 billion in companies in the UK and beyond. So please join me in welcoming Jon.
Well, mostly we've got an audience which is interested in the smaller end of the quoted markets, so why would you want to be there? I'd argue actually it's probably more fun to be there nowadays, as the first point. The large companies are so utterly process-bound and spend all their times doing mutualist 360-degree assessments and ensuring they've got their sex and disability quotas right on the board. You're probably enjoying missing that stuff. Anyway, let's go through a few things. First of all, the government really loves small companies. We probably have the most supportive set of things that you can imagine to prop up smaller companies in the UK. All these income tax reliefs, capital gains tax reliefs that come with that lot, admittedly comes with it some complexity, but many of you are grateful for that. That's what provides a reason for your existence. You've got inheritance tax relief, which is one reason to buy the shares, though it is a fairly dull thought that the only reason you're buying the shares is so that you can die. Stamp duty now, very nice on the aim. Entrepreneurs relief works for quite a lot of people. Very, very capable of being abused, to the great joy, again, of some of the more complex members of the audience. R&D tax credits, very valuable for small companies, very valuable. With a bit of creative accounting, you can pretty well fund a company entirely through that. And then there's all kinds of other bits and bobs around various government schemes, whether it be the Technology Strategy Board. I always want to call it the Trustee Savings Bank, but of course that's coming back in its own right shortly. The government love you. Very popular with cable, very popular with Mr. Hancock, who was here this morning. I think there's genuine goodwill in the government towards small companies. Whether that's for the right reasons or ignorance hardly matters. You are still going to be the beneficiary of a lot of government help over the years ahead. So that's one good reason to be a smaller company, and it's a bit painful when you cease to be one and lose most of these things as you either move to the main market or get too big to be past the thresholds. But there is another side to it, and you've got all the regulation and governance now of being a public company. Now, I'm actually quite elderly, so my first flotation, I think, was back in 1985. It was done on a prospectus which honestly wasn't that thick. And amusingly, for those of you who see modern prospectuses, it contained an account of what the business did, and very little else, actually. So it was quite useful for people who wanted to invest, as opposed to just something completely pointless. It's odd how comply or explain has become essentially do it or else, and it really has nowadays. Very, very few people explain. Mostly people comply with the rules, which are getting very thick. It's getting also virtually impossible to find anybody who actually knows all the rules. Things like the takeover code have exploded from something which it was quite feasible to learn in an hour to something which it's not feasible to learn in a month's course, and you would actually question the need for existence at the end of such a course anyway. So it's really getting quite bad. It's mindless drivel, and there's so much of it. Don't forget, the more you actually disclose, the less likely it is that anybody will read it. It's a really important thing to get your head around. And what is the response of our regulators nowadays to everything? Transparency, disclosure, mandated disclosure. More and more and more and more of it. And less read. You're less likely to read a prospectus than you are Google's terms of trade, which are enormous, by the way, if ever you want to try clicking into them. And this is what happens. We end up with enormous amounts of effort putting out useless paper. Good again for a small portion of the audience who make their living producing this worthless rubbish. And indeed, it provides useful employment to people who otherwise probably couldn't get employment. But you have to think there'd be a better use for the economy than them spending time producing this stuff. We really desperately need to turn this stuff back, because it is nothing but a laughingstock now. You don't read a set of annual accounts. If you talk to the directors of most companies, they really haven't read the accounts. They couldn't bear it. Very few analysts read accounts. Very few write-ups even notice. I found to my amusement that bank accounts clearly are beyond the ability of most analysts in the area. They fail to spot the differences in accounting policies between banks because there's 300 pages to wade through. So actually the weight itself makes things less and less useful. And how much money do you all waste doing this when you do an IPO or fundraising? It's something to be driven backwards. And there's more coming. As time goes on, the lads in Paris who would like to take over from London would like to inflict even more wasted time on you, producing more and more worthless guff for nobody to read. We have to find a way of stopping this. I don't know quite how we're going to do it, but we definitely do. Right, so now let me just move on to my latest favourite line from the FRC. I hope that's readable, but I'll just go through it slowly. The directors should state whether, taking account of the company's current position and principal risks. By the way, the FRC now regard the word principal and significant as interchangeable for the purpose of the code. So don't assume that the English means English anymore. There's a new language as well, just to make sure that the people at the FRC are irreplaceable. They have a reasonable expectation that the company will be able to continue in operation and meet its liabilities as they fall due, drawing attention to any qualifications or assumptions as necessary. They should indicate the period covered by this statement and why they consider this period to be appropriate. Now, it's a pretty intelligent audience. How many of you feel confident in predicting the future of a company 10 years out? How many companies are actually predictable 3 years out? Very, very few indeed, possibly a water utility or something like that. So what are you going to put in your annual accounts? The directors think the company is good for another 3 years. Should do wonders for your share price, shouldn't it? Do wonders for your suppliers, your customers, your overseas competitors who won't have to put this kind of nonsense into your annual accounts. What happens if you have a meeting and you decide that it was 10 years, but now things are a bit worse, you're going to move to 8? You can imagine the headline across the front of the FT and the City AM. You know, company reduces expected life by 3 years or something. If you've got a pension scheme, if you write 10 years in for this, how can you possibly fund that pension scheme for closure on a period which is longer than that? So that could actually drive you to massively increase your pension contributions, which would, of course, result in a shorter life for the company in the first place. Why would anybody come up with this rubbish? But they do, and it can barely be stopped. In amongst the walls of things that come out now are walls of consultations. And this thing's been through 3 different types of consultation. At this stage of the proceeding, the people responding to this very long, very detailed and complex document have to be trained spotters par excellence to still be at it. And the only people who really provide any kind of commentary on the consultations are those who have a vested interest in the increased complexity in the process. So the corporate compliance director of an asset manager, for example, who really loves things to get more complicated. the big four accounting firms who would like yet another report to have to review. Directors want it, utility, cost benefit, not there. I don't know how we get this turned around. It needs political will to actually get it around. And it would be a huge advantage for London to have shorter, clearer, more understandable documents rather than lots of worthless mandatory disclosure to be unread by everybody. It's got to go. Anyway, I'll move subject a bit. Just to remind you, these are not the peaks and troughs, but they give you an idea just how incredibly variable the small cap world has been. 1995, 10 companies, 82 million quid's worth. I took one of those 10 companies private about a year later. By 2006, £10 billion. I don't know what the average fee on that for the broking community is, but probably 3 point something. So a lot of fees swirling around for the nomads. At which point there would have been, what, 60 odd, something like that. 2008, 740. So 300 or 400 million of fees has become 20 odd. The industry collapses and the number of nomads goes down by about a half. Very unlikely that there were as many as 10 profitable nomads in 2008. But it's swinging back again. Number of companies is going up. We've got about 3 billion run rate of funding, though how long that'll last is anybody's guess at the moment. But it is a very, very volatile world, and people forget that. It actually makes it quite difficult, I think, to staff the industry appropriately. Because if you're a stockbroker living out of that fee stream, you cannot maintain your staff at the peak levels all the time. So you're talking about quite a lot of years where people have to take lower pay or another job. And that's not really good for the continuity of quality. It can't be helped, I think. Right, so, well, that's what we get today. I'm a private equity man, and for the first time in years, the private equity firms have discovered they can dump their interesting companies into the hands of the stock market. It is extraordinary how euphoria takes over stock markets. I mean, the idea, if you'd come out in 2009 and said, I'm going to do 100% sale of my stake in a company via an IPO, you could probably have been subject to the Mental Health Act. This year, it's happening time after time. And the institutions are surprised that some of these turn out to be pretty weak issues. Just think about it for a second. 100% sale, no warranties, nobody at the table with any desire other than to complete the flotation, whether it be the stockbroker, the accountants, the management team who are probably on a flotation bonus of some scale. Everybody wants to get the company out the door. So all the ingredients are there for an overpriced issue. And yet the market gets emotionally wound up, oversubscribes these issues, and piles into them. Fascinating how fear and greed move around. There's very great diversity in what's been happening. You can see more of them coming through. These figures are a few weeks old, so they're already stone dead, I think. Everything's coming up market again. Everybody's getting happier. But we're starting to see, actually, some of the things aren't really performing terribly well. There are some worse examples, and there's now some very severe examples. Some of the companies really startle me that they've been able to get away at all. They don't seem to be based on very much fundamental analysis, probably mostly a belief that the issue is oversubscribed. That generates a massive number of loose holders, and in the small cap area, you only need a couple of big loose holders and the share price is doomed. There's all kinds of different things. You probably can't read that. That shows stuff anywhere between dropping to a 20% discount to a 70% premium in the first month. The markets go all over the bloody place. It's really weird how it happens. Okay, so I was asked to talk about how you're supposed to succeed in the public markets. Now, the definition of success in public markets is above all a function of the time you measure it. Shares go up, shares go down. That much is certain. Very few people manage the Warren Buffett style of most decades of going straight up. So if you want to really get your share price up, you play the bubble games. Very straightforward. You start buying companies that you own a share in. This is a very good technique. You can win on both sides, and you have a broad discretion on how you report the numbers. You do a lot of acquisitions, many of them at very high speed, and many of them with the same people. You see this pattern quite often, and I've already given you enough, I think, to predict the failure of quite a lot of companies. You don't worry about cash flow. So what are we looking at there? Typical IT industry conglomerate. Pilots are really not so much a buy and build, but a buy and stack strategy. Just heap them up. You ramp and raise. You report good news, you take full advantage of the accounting, and you raise more money. Now, on some definitions of success, particularly those favored by the investment banking community, having done all these things, you are now a successful share. Your share price will be up, you've got some followers. But it is a short and merry life, because eventually the absence of cash flow blows you up every time. So I'm not recommending this as the way to prosper in the market, unless you're terminally ill, in which case feel free to try it. Real performance is much easier. Good numbers, reliably produced, roughly in line with expectations, people buy that. That'll keep you in business forever. It's not always easy to do. Some businesses are fundamentally very unstable, and getting reliable, routinely good numbers, particularly if you're quite small, is difficult. Smaller companies typically have more volatility of earnings because they're less stable, their markets are less stable. So getting good numbers all the time is hard. Have a good team. Now, there's a whole half-hour speech on this, but there's two types of good team in the smaller cap market. There's the good promoter. This is the bloke who can give you a world-class presentation, but actually doesn't know anything about the bloody business and can't manage, but he can present. He's really dangerous, and most of you will have suffered at the hands of one of these by the time you've been in the trade for a few years. The ones you want are the austere people who have a really thorough grasp of the numbers, the markets, the dynamics of their business, and you can ask them all kinds of questions outside the PowerPoint presentation, and they get the answers right. The world I live in of mostly doing turnarounds, actually these people are the people who are just presenters, turn up, they've got terrible companies, but they've got a great PowerPoint presentation. You ask them a question outside, they can't answer it. You meet people who've never visited some of their own sites, don't know how many people work in the business, things like that. It's amazing how much bad management there actually is out there. Good advisors. Now, small cap markets contain a very large spectrum of advisors, whether they be accountants, lawyers, stockbrokers, or whatever. If you've got good advisors, you have a much greater chance of being a successful company. A good advisor is not the one who will float you on lousy prospects and dodgy numbers, because you won't last very long. A good advisor is the one who gives you the right view on a problem in a prospectus or in a results announcement, not one who actually tells you how to fiddle their way through it and round it. Those people don't last very long. So get yourself good advisors, right at the top of the list. Treat investors with respect. These folks are customers. They deserve to be given the facts. It's quite often difficult to do that properly in the public world because of the insider trading rules, equality of information. And I personally find whenever I'm dealing with investors, I'm forever struggling with wanting to tell them more than I actually can or should. And I undoubtedly occasionally breach the rules, as I'm sure most people do. But investors deserve respect. If they want a meeting, give them a meeting. If they want numbers, if you can, give them to them. If they want actually to go and visit the factories, let them go and see them. Simple communications matter most to investors. Nowadays, this is getting a bit more complicated. You've got a PR firm turn up and they'll suggest you should be using social media, the net, have a really nice big glossy annual report, possibly even events and parties. But actually, the direct contact with investors beats them all. The other stuff's not valueless, particularly if you've got a large shareholder base or if you've got a very retail base. But typically, the main thing is to remember most smaller cap companies, if you look at the top 10 or 15 investors, you've probably got the company's main ownership dealt with, and you need to talk to them directly. They're not appropriate means of being dealt with through the press. Fancy annual reports don't matter very much. It's really interesting. The best advice I can give you on annual reports nowadays is put through a resolution to your shareholders telling them that they won't get a hard copy unless they really ask for one. You now ascertain the real demand for annual reports by the fact that virtually nobody will ask for a printed report. So they're not read. They're not needed. Probably better to put much of the information onto your website where there's more of a chance that somebody will read it when they want to dip into it. But the spending a lot of money on annual reports nowadays, I think, really a waste of time. Sorry, I think there's a session on it from looking at one of those outside, so I'm sorry if I spoil somebody's afternoon. And then the bit that I've always struggled with, no surprises. No company I've ever been involved with seems to have the ability to avoid surprises for any length of time. But I'm sure if you can avoid them, you'll end up with happier investors on the whole, unless they're always very good surprises, and that's even harder to do. With that, I'll shut up and take a few questions. Thank you very much.
Well, I think we have time for just one question before we go to the breakout group. So who's got the killer question for Jon?
Now, that's a way to dissuade questions if ever I saw it.
Jon, what would you see as being the biggest challenge that a company joining the public markets would have these days?
Biggest challenge? Adapting to the corporate governance / public relations bit. That's the bit that changes from being a private company or a private equity-owned company. The public face, the interactions required to deal with your investors. They cost money, they cost time, they need a different attitude. That's the biggest thing to change. The rest of running the business ought to be broadly the same.
Okay, Jon,
Thank you.
Please join me in thanking Jon.
Thank you very much.